So Rebecca, we got Joseph on the line. What do you want to ask him?
What's your advice to newbies that are starting something on their own?
Surround yourself with very experienced people. When I got started, I didn't know anything about multifamily. I thought I did. I read books. But as you start off, you're going to do a bunch of joint ventures with people. And then eventually you'll see some that just naturally stick. Either you'll have the right personalities and characteristics and skill sets. You'll recognize that, hey, this team makes a lot of sense. I can build something with this.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We got two amazing people on the line with us. I think we have third-time podcast guest, Joseph Bramante, and first-timer, Rebekah Taylor. So, guys, welcome to the show today.
Hey, glad to be here. Glad to be on the show again.
Awesome. So, Joseph, I think this is your third time on the show. Is that right?
Yes, it is my third time. We did... Yeah, it's been, where's my buddy?
Heschel.
Heschel. Yeah, where is Heschel at? I need to catch up with him.
Heschel. Yeah, we, for those listening, we had Joseph pair up twice with Heschel as the aspiring investor. And incidentally, I think you guys were still the longest running top of the line show. Interesting fact, where's Heschel? His first deal episode is now at the top of he's now the most listened to episode. So anyway, that's where Heschel is. He's at the top. So
awesome. Happy for him.
Cool. Well, hey, Joseph, do us a favor. Tell us about yourself and get us caught up from last time we talked.
Yeah. So engineer, former Exxon, and just kind of stumbled into this multifamily thing back in 2011. Bought an apartment complex just as an investment property. Mm-hmm. It was me and another colleague at Exxon. I had convinced him to go in 50-50 with me and had more money than sense back then. Bought this one sight unseen and kind of went through the ringer on that first property and almost lost it, turned the whole thing around. And from there, kind of launched our company. Mm-hmm. So since then, we've done about $375 million in transactions, currently sitting at about 240 in assets under management. Nice. And we've pivoted to new development in a big way. So we've already, this week, we broke ground on our first property. So excited about that. We're still raising some equity for that one, but we broke ground on it. And then we've got two other sites that we're breaking ground on later this year. So we've really leaned into the new development space and continuing to, really just to complete the cycle. We wanted to be able to buy and develop properties. So no matter what's going on within the cycle, we can stay active. Yeah. And this Friday I will be, so it's May 5th, or it's May 3rd right now, but on May 5th, I will be graduating from Rice University with my MBA. So that's what I've been up to for the last 2 years.
Yes.
I've been kind of a little bit busy, working 60 hours a month of additional overtime. But nonetheless, it's been a wild ride. So learned a lot.
That's something that I was actually going to ask about, because I know that you've, based on all that stuff, I knew you were at Rice, but you really are big into education and becoming better. So, you had a pretty good thing going on. Why go to Rice? Why add that extra stuff to your plate? And why get the MBA? And the follow-on question is, how's that helped?
It's a good point. And actually, a lot of people were discouraging me from getting my MBA because I said, all this stuff. You don't need all this. You're already successful. And it's, true, but man, you just get a lot of confidence is what you get, to be honest. As if that was something I was short in, but now definitely going into these rooms when you're talking to these, different groups, these family offices or whatever. Before I felt like just an engineer and I never really knew what it was that they knew. Like, was I missing something? I always had that question in my head. And now I don't have any more questions. Now I know what they know when it comes to the business side and the finance side. There is no other secrets out there that are to be determined. And so now we can just put our foot down and go.
Nice. And you also have your CCIM designation as well. Same reason for that?
Yeah, I didn't know anything, and I got into the first deal, and I saw how expensive it can be when you don't know what you're doing.
Yeah.
And because it was my own money, and I was like, I don't want to make that mistake again. So I've got the designations.
Mhm.
I've always been a proponent of academia, engineering. I wanted to, master my craft, and I treated multifamily the same, get into it. And I wanted to really understand everything that was going on before just doing a bunch of marketing and throwing a bunch of money at deals.
Yeah. Anyway, that's something that I really respect about you. I mean, you were successful, and you keep on adding letters to your last name. It's not just vanity metrics. I think you're doing it for the right reason. You're getting better, and you're able to run your business a lot better too. So
Yeah.
Cool. Now, also recently learned that you guys operate off of EOS, which is something that I'm just jumping into. Now, did you guys tackle that yourselves, or did you guys bring in an implementer on that one?
Both. We were a much smaller company at one time, and so these implementers are not cheap.
Nope.
And so we self-implemented back in 2015 or so.
Okay.
And we did it like 80%. But then whenever we got a real implementer in place, it was a noticeable difference. It was basically like going over the whole thing again. And I feel like our company was reborn because just the clarity you walk out with. So either way, I think it's a fantastic system, whether you self-implement or you get a professional implementer to come in and do it, but just do it.
Yeah. And I posted on LinkedIn that I had started with an EOS implementer. And when you chimed in on that post, I just thought it figures, I mean, they seem to be like a group that's operating at that level. So now I'm going to ask you some questions. I'm going a little bit off my own script here, but I'm going to ask some questions selfishly because it's where I'm at right now. What do you think was the biggest factor that helped you to scale from, that first apartment building, which I think you bought when you were overseas, sight unseen, to where you're at right now, where you've got, hundreds of millions in assets under management and everything else?
You just gotta be patient, man. It's, I see the same news feed that you see, and it just seems like people are buying deals all the time, and like they're flying by you, and you put all this pressure on yourself. And I say ignore all that stuff. You just kind of go at your own pace. We were buying one deal per year for like 10 years. Like it was like the longest time we're buying at a very slow pace. And there are a lot of people who bought a lot faster than me and have grown much bigger portfolios. And that's great. But you just got to go at your own pace and not get caught up in all the marketing aspect and trying to compete with everybody. So for me, we just wanted to grow at a pace that we felt comfortable growing at, because I had to learn the industry, so I just didn't feel comfortable putting my foot down and going, a million miles an hour when I still had all these questions about how everything worked.
Yeah.
And I think everybody gets that. I mean, you get the surface level understanding pretty easily, but for us, we really wanted that second and third level understanding of how it relates. And, I was listening to somebody's post the other day, and they were saying how like underwriting is an art and a science. And I agree, there's some art components to it. Yeah. But what we were trying to do was we were trying to eliminate as much of the art as possible. And we've done that to a large degree. There are still some parts of it that are art, but I'd say for us, what we noticed was the quality of the underwriting. We were going into these deals really depended on how much art versus science people were approaching with. And so the more science that you see that you could approach a deal with, and the less art, then the better likelihood you would have of achieving your numbers.
Yeah, absolutely. And for people listening, if you have a chance to hop on a webinar that he does, he goes into a lot of detail on their underwriting the webinar. And I may or may not have sent a couple of, old video links to your webinars for my my new acquisitions guide to look over. So I did, to be honest.
But, we took the time during this last winter break, and we've just completely overhauled everything because there's no deals to be bought. So I said, all right, well, let's take all like the Band-Aids that we've been putting on things as you do. And let's just completely overhaul it. And so that's what we did. So you'll have to tune in for the next one to see what it looks like now.
Sounds good. Certainly will be there. Well, awesome. Now I'm going to circle back to what you said earlier, into the development space. So can you go a little deeper on why you're making that transition from, buying existing to, buying a raw patch of land and developing?
So we're not buying raw patches of land. We're buying existing apartment complexes that have a
Okay.
great basis that we can then go in and tear them down and build new apartments on top. And we like that model because one of the big drawbacks to development is you don't have cash flow.
Right.
So you buy just dirt, there's no cash flow coming in. So we're kind of doing a hybrid where we're buying an existing asset. There's some cash flow coming in. It's paying the bills.
Yep.
But when we're ready to tear it down, our only downtime is from the moment we tear down to the moment we're leasing back up again. So it decreases our exposure in general. But we made the switch because back in 2016, you were seeing prices get very close to construction cost. And we knew it was only a matter of time before it just would make more sense. I mean, why would I buy a 1980s asset that has all the problems that an 80s asset would have when I can just spend a little bit more money and build one, have a brand new asset, and maybe my basis, so like my construction costs or my all-in costs is equivalent to that purchase price of the 80s asset. So then now I can just refinance and basically get the cash flow of a Class A, but the price of a Class B.
Yeah, that makes total sense. So you're coming in, you're buying existing, you're operating them. I assume during that time, you're getting your engineering plans all drawn up, going through the entire processes, your permits and everything else, selecting your builders. So you're cash flowing. Whereas if you buy a raw patch of land, you got zero income.
Correct.
Okay, cool. Interesting. So how old of buildings are you typically buying right now?
Right now, we're not buying anything. It's we're just sitting around. We're focused exclusively on new development because nothing's making really sense on acquisitions. And I mean, I think the Fed's supposed to be bumping rates up, hopefully for the last time, or 25 bips.
I hope so, yeah.
And so we'll see what happens, but we're not seeing anything. There's still a pretty big spread, big buy-ask spread when it comes to acquisition. So we're not really doing anything there. Our focus is just on our existing properties, operating those really well, and then doing our new developments.
Awesome. Cool. Well, question that you probably know is coming because you've answered a couple times before, but what's your big burning why?
For us, the why is just trying to find a better way to do things, whether it's through acquisitions, through buying deals, through investing, and just trying to get the ultimate scenario. Like we do things a little bit differently for our investors. We offer single family flips on the side, which is something like most multifamily people are like, no, like you can only do multifamily. Multifamily is the way. And I'm like, well, it depends, right? Depends on how much money you're starting with. Single family is a great asset. And we've created vehicles for our investors to go into that and then help them grow into multifamily. I've got this whole concept of small money and big money, where you take your small money and make it into big money, and you take the big money and put it into multifamily deals or bigger investments. So really it's just trying to find that better way of investing. I'm writing a book right now. I just saw the first manuscript of the first few chapters, and it's really, really exciting when you start to see it come to fruition. It's a book about passive investing, about winning strategies for multifamily passive investing. So we kind of take everything that we've done and outlined in our academy, the Passive Investing Academy, and we've condensed it down to a book, which is something that, similar to Brian, he's got that book, The Hands-Off Investor, which I think is a great book. And ours his was very definition-based. Ours is more application and strategy-based. So we you really need to buy both of them. I don't spend a whole bunch of time like defining things for people. I assume that you've got this. But anyway, it's about helping investors invest in deals in the right way, because we've seen a lot of people do deals the wrong way. We've seen recently in Houston. I'm sad that it was my city, but 3,200 units foreclosed on just last month from this sponsor that just didn't know what he was doing, just grew way too fast. So,
Well, cool. So last question, and I think I can guess where this is going, but what's next for you?
So what's next for us? More development. We're going into more on the passive investor education side. When the book comes out, planning on doing more talks and speeches, and really leaning into our Passive Investing Academy and the Passive Investor Conference. We did that earlier this year. We're doing it again in August, another virtual conference, just to try and teach. I enjoy that side. I got our teams fully built out now. We got dedicated people for every position. And so my whole job is just to get out and talk to investors all the time and try and educate and provide opportunities. And
Love it.
that's really what it's about.
Awesome. We're going to switch gears and bring Rebekah on. So Rebekah, welcome. How's it going?
Thank you. Good. Glad to be here.
Awesome.
Appreciate
Glad
it.
to have you. Yeah. So do us a favor. Tell us a little bit about yourself.
Yeah. So I'm in Lynchburg, Virginia.
Mhm.
I am a mom of 2 kids. My husband and I have been married almost 15 years now,
Mhm.
and I have a degree in public relations. I also have my MBA, and
Nice.
I learned about real estate from my dad back in 2004. So for
Mhm.
many years, I've been watching him kind of on the sidelines. Back in 2011, my husband and I bought our first rental property
Yeah.
and just did it very much on the side. I spent about 10 years in the tech world doing sales and marketing,
Mhm.
did really well in that space, but got burnt out and realized that that's not exactly where I wanted to spend the rest of my life. And so
Yeah.
back in 2020, went on a 3-month sabbatical with my husband.
Mhm.
We traveled around the country with a camper in tow and
Nice.
our 2 kids. And we were just trying to figure out, what's next. And I was really asking myself, what do I want to do with my life? It was in my 30s and I'm trying to redefine myself. And so I was like,
Yeah.
man, I love real estate. I think that's where I want to go and spend my time,
Mhm.
full time. And so we ended up buying additional rental properties. We had
Mhm.
paid off our house. We were debt free. We did a cash out refinance and used all that to go out and buy more rental properties.
Nice.
I got my real estate license and I was like, okay, this is cool. And then I stumbled into passive investing and
Mhm.
connected with a private equity firm locally and came on board as their director of investor relations and have been learning about that space ever since. I didn't
Mhm.
even know it existed before. And I was like, wow, this is really cool. I love the fact that I can help friends and family and people that are
Yeah.
really great at their jobs, as doctors or lawyers, whatever they're doing, but still have an interest in real estate and they want to invest in it, but they don't want to be a landlord. And I know what it's like to be a landlord. It's
Mhm.
a lot of work, and so
Yeah.
be able to help them and still take advantage of the benefits of real estate in a very hands-off way is
Yeah.
pretty cool. So that's what I've been doing the last couple of years. And
Awesome.
I'm in the process of launching my own kind of business and
Mhm.
learned a lot on the investor relations side. Now, it's kind of undertaking some of the other pieces
Mhm.
that Joseph and you, Brian, have had the chance to do
Yeah.
for many years. And so it's fun to learn from, folks like you.
Yeah. I think that's a great way to get in. I don't know if it was intentional on your side or not, but it sounds like it's straight out of the Rich Dad Poor Dad book where you go get a job because you want to learn something specific. So whether it was intentional or not, I think that's a great place to be right now to learn, aspects of the business. So awesome.
Yeah. So it's been fun. I'm excited. So
Mhm.
Joseph, thanks for all the insight that you shared. This was really, really enlightening. And I appreciate just the years of experience that you bring here today.
Yeah.
Thanks. Yeah, no, happy to do it. It doesn't seem like anything, for me, just great to have conversation. You kind of forget, Brian, you've been doing it I've been doing it for like 12 years now. And for me, I still feel like it's just yesterday, I can still remember buying that first one.
Are you in Papua New Guinea when you bought that first one?
Yeah, I was in Papua New Guinea, same place where I got my little statue back there. Can't really see it. But yeah, it was a fun experience. Very grateful for it, and don't think I could have done it without being there. And that was kind of the similar concept of I knew to be successful, I had to make a bunch of money as fast as I can early in my career. So I took the assignment that was going to pay me the most money, which was Papua New Guinea. It was the roughest one. It was the hardest one, but paid the most, and it gave me the funds I needed to get going.
That's great.
Nice. Well, Rebekah, one thing I want to ask you before we get into the question answer is, what's your why? And then we'll go straight into that question answer.
Yeah, that's a great question. So I think
Yeah.
for me, there's a couple of whys that I have. One of them is just freedom, time freedom, and also just freedom to choose what I want to do. I've gone through a layoff due to financial difficulties with a company, and it's pretty painful. It's really hard, and to experience that is something I don't want to do again, So, and luckily, my husband and I had made some really wise decisions financially with streams of passive income, and that prepared us to be in a position where when I did, go through a layoff, could handle it. And I'm just so thankful that we had prepared, and I wanted to teach other people about that, how to prepare financially for their future. And there's so many different aspects of what that looks like. It's not just financial preparedness, but also just being wise with investing in all aspects of your life so that you are healthy across the board, in your relationships and your physical health, your mental health, spiritual, like all those different avenues of life, I think are really important. So I'm really passionate about not just teaching people about how to invest financially, but how to invest in other aspects as well. So that's a big one. And then just the time freedom to invest in my family. Like I said, I have 2 kids. They're a daughter that's 7, a little boy that's 4. And so it's just fun to be able to be with them. We love to travel. My husband and I have been to over 30 countries. We go somewhere new every year. And so we're just passionate about, getting to see the world, but also getting to give back. So we do a lot of missions work around the world. And that's another reason I just want to be able to be in a financial position where I can continue to give and also have the time freedom to give, around the world.
I love it. I love it. And thanks so much for sharing that. Yeah, here we come to the part where we try to help you as much as possible. So Rebekah, we got Joseph on the line. What do you want to ask him?
Absolutely. So I'm curious, hearing a little bit about your story. You started off on your own, and then it sounds like you brought some partners in early on. And I'm just curious, what is your advice for somebody starting a business? I've had the chance to work at a couple of other firms and learn a lot from them. And now going out on my own, would you recommend partnering up with other people that complement your strengths and weaknesses? What's a good way to kind of take your business? Because I understand and know a lot about the capital raising piece and investor relations, the sales and the marketing, but I struggle on the underwriting front and some of these other pieces that you need, and so what's your advice to newbies that are starting something on their own?
Surround yourself with very experienced people. When I got started, I didn't know anything about multifamily. I thought I did. I read books. But as you start off, you're going to do a bunch of joint ventures with people. And then eventually you'll see some that just naturally stick. Either you'll have the right personalities and characteristics and skill sets. You'll recognize that, hey, this team makes a lot of sense. I can build something with this. And so for me, I just got lucky. It happened very early on. On my first deal, the first property manager didn't work out. We fired him, brought in a new lady. And she was just fantastic. She's my partner today, Carrie Brenneman. She really kind of got us out of a bad spot on this property. And then so we went forward. We did 2 more deals together as a joint venture between myself, and she had her own property management company. So she owned a boutique property management company, and they had 3,000 units they were managing. And so I was trading equity in these deals for a decreased fee. And so that was kind of how we got started. We did that for a couple of deals. And then after that, a couple of years went by, and I said, hey, things are still going well. Let's go ahead and make this official. And so we went and we partnered and formed our company, Triarch. So there's a little bit more to the story. There was one partner who didn't make the cut, and we brought in somebody else. That's just part of the process, right? So I would say don't be too eager to joint venture with people. It's perfectly fine to just keep it professional for a few years and just observe and see how things are. A lot of times people just try to hurry up and partner up quickly, and I don't think that's necessarily correct, because it's really easy to partner up. It's really hard to unpartner. And that becomes the problem.
Yeah. And I just went through an unpartnering moment, and I think it's right. I think you're probably better off delaying that decision, more like Joseph did. I jumped into it pretty quickly. We bought a lot of properties together. We did well as far as the numbers go, but end of the day, unpartnering is difficult. But I would say, and Joseph mentioned this, be around a lot of different people, and you can see how other people are operating. It sounds like, you got a pretty good handle around the capital raising piece. So when you start looking at how other people are operating, you might see somebody who has a fund and they're acting as a fund manager, and that's how they're raising capital and deploying capital. And that might be something you want to do. Or you might look at somebody like Joseph's company, where they have somebody on staff who does each different role of the entire thing. So part of it depends on, I think, what you want in several years. Look towards the future and say, would I rather be one person, fund manager, or build out a fund management team? Would I rather be part of a team that does everything? But yeah, part of it is just getting around other people, see how other people do it, and then letting that, slowly simmer and deciding, okay, this is the direction I want to go.
The other part I would say is, whenever you go through these partnering processes, there's a moment where everybody comes to the table and they try to figure out, okay, who's bringing what value, and you're putting a dollar to that. And so if you try to do this too fast and you don't have a lot of experience, then you're going to get a very small piece of the pie.
Yep.
But if you can build yourself up by just being patient and getting a lot of experience and doing things just kind of on a transactional, then whenever you do find the right team and you are ready to, come together, you've now built up your portfolio to a point where you can command a much higher piece of the pie.
That's great advice. Yeah, I was talking to a friend recently that's in this business, and she said that she always invests first as an LP in the deal before she'll go and partner with them. She wants to see the results, And so I like that approach. The one challenge is obviously you've got to wait it could be a 3 to 5 year hold before they exit the deal. So, having to sit on the sidelines for that long before, because from my strengths, like just knowing myself and seeing the role that I played the last couple of years, I know that, going out and deal finding across the country and underwriting, that's not as much of a strength for me. So being able to, again, partner with other people, I think is a good option, but I totally agree on waiting and making sure that it's the right partner, because you're right. It takes a lot of time to unpartner. And so why get yourself into that situation?
Yeah. And to that point, so one solution, and I talk about this on we've got this multifamily checklist for passive investors. And one of those comments, when a sponsor doesn't have a track record because they haven't been in the deal long enough or they're too new, but they have done a deal, one of the things that you can look at is how is the deal currently performing versus what was it projected to do from the pro forma. And so that way you don't have to wait 5 years from the exit. You can say, okay, look, you've owned it for a year, and let's see how your current NOI and financials compared to what your pro forma was.
Yeah. You can also see communications, how transparent they are, how they deal with problems. I think that's a big issue too, is how do they deal with the problems that come up? And, are they handling things properly? Are they making, good decisions on things? I agree. I don't think you have to wait until the deal comes full cycle. You just have to wait long enough until, whatever that is, but long enough till you're comfortable with them and vice versa.
Absolutely.
Yeah.
So in terms of making connections, Joseph, what do you feel like it's been? I would assume you're doing events and maybe some masterminds, or, what kind of things have been most helpful for you in terms of connecting with other people in this industry?
So I'm pretty active on LinkedIn. I do a lot of conferences. And then in Houston, we have a really strong network of real estate investors. They got 2 very large real estate investment educational groups. And so we've just got a very active networking community. There's lots of meetups, et cetera. So I'm not sure how it is in your market, but in Houston, it's very active. And so it's very easy to meet people.
Yeah, that's great.
I would say take advantage of anything local, but, now there's so many groups that are online. So you can find whatever you want, whatever type of groups you want on Zoom meetups. But conferences are amazing, and especially the ones that are focused around the areas you want to invest in. You'll see like Mid-Atlantic conferences, Midwest, whatever. But you'll see a lot of different conferences that have a regional focus as well. But yeah, I would say get up, go travel, and maybe take your husband and kids with you and go visit a lot of these conferences.
Absolutely. Yeah, there's a lot of good ones out there.
Yeah.
Sure. So Joseph, I guess I'm curious about we talked about track record a little bit. What type of, for you, the last couple of years, I'm curious about the type of debt you've taken out for your properties. Are you looking mostly for fixed debt in the past, or was it bridge debt? And what's moving forward? What's your future outlook on all of that?
Yeah, so last year we did 2 big transactions. One was a debt fund, the other was bridge. And we did, interest caps on those. We're doing big renovations. So our bread and butter has been renovations. We've got a construction company in-house. So it really lends itself to doing those large renovations. So therefore we were looking for bridge debt and debt funds. But most of our other stuff is long-term debt. We got 10-year deals. We got some regional stuff. And now we're in the process of refinancing some of our deals into fixed rate debt. So I think same thing as everybody else is doing. We're just trying to manage your debt right now. It's a very interesting time, and those who bought right or were able to increase the value enough are doing well. Those who didn't are not doing well. So
we were fortunate to have fixed rate debt on everything. The loans that should have probably been bridge loans by our plan. We were able to find local lenders that were giving us a similar bridge product with fixed rates. So that's one thing that I'm very grateful for is, we have everything fixed and most of our rates start with 3s and 4s, so yeah, I think, yeah, we're in a good spot. I don't think it was anything, I didn't have a crystal ball. We just found good products from local lenders. And I don't think we were intentionally doing it that way, but it ended up working out for us.
This is a question for both of you. I mean, have you been able to, through the last year plus, continue to pay distributions to your investors? And if not, how are you handling that? Like, what's your approach and how are you communicating that with investors?
Yeah, so for us, we have been able to continue to pay distributions. We had one property that was paying, and then we had to stop because we had a whole building catch on fire because the lady moved in and put a box on the stove. So that kind of slowed things down, and then got it rebuilt. Maybe those things take time.
Yeah.
And then the other two, we had sold 2 last year and bought 2. Those we had bought them right as the rates were going up. So we had bought them. We actually did a re-raise on 2 of them. So we didn't do a cash call. It's optional. We did a re-raise with special terms to try and make it more attractive for people to come onto those deals. But we didn't do distributions on those because we're doing a big renovation. And we do have an interest reserve right now that we're tapping into, and we're just watching the interest rate and trying to manage that whole process. So on those 2 particular ones, we're mid-cycle on a renovation, not doing distributions at the moment, but everything else is doing well.
Yeah. Yeah. And as far as the not doing distributions, I think the important thing is that you just communicate with people. We've had a couple where we haven't been able to do distributions. One of them wasn't a fire. It was, when you buy 70s vintage C-Class, to Joseph's earlier point, you come with 70s vintage problems. And we had one property where we had, the city county inspectors come out and condemn an entire building, so roughly 1/10 of our units were vacant for a while. So it took us several months to get that one back online, but during that time, we weren't able to push distributions out. And then in the last year, we've been net sellers. We've sold a lot more in the last year, partially due to the unpartnership event that we had. It just ended up being still a decent time to sell, all things considered. But we've been net sellers instead of net buyers like we were in 19, 20, 21.
Mm-hmm. That's good.
So,
yeah, thank you for the feedback. I appreciate it. Okay, 2 more questions. I'll be fast.
Mm-hmm.
Joseph, so you mentioned it's hard to find anything to buy right now and you're switching more to focus on education. Have you considered alternate asset classes, or is multifamily where you always want to be in development? Is that really your space and you don't think you'll ever veer away from those asset class, that asset class?
No, looking at buying 2 companies right now as well. So one of the benefits I got from my MBA is you learn how to buy other businesses, and those are attractive. You get good cap rates.
Yeah.
They're not much, the market's not as mature, so your ability to exit those businesses isn't as certain. It could take you years to sell one, but they certainly have very attractive components.
Mm-hmm. Nice.
Great. That's great.
Nice.
Last question. I saw in your bio that you mentioned that you really you have a goal of helping as many people as possible achieve early retirement. I think that's really cool. I love that. How is that goal coming? Are you able to track that progress? And are there specific things that you're really seeing work as you help people achieve that?
Yeah, it is something that I don't think we've tracked it per se. We've got a lot of repeat investors, and I've got a lot of investors like my first one who could retire if he wanted to, but he just, why? And so it's not something we're tracking necessarily, but we do help a lot of other investors as far as, creating these past investor roadmaps for them, where we sit down and we say, this is what you're starting off with, looking at their balance sheets and their liquidity and all that, and their goals, and we kind of lay out a roadmap for them where we say, okay, well, you should do these types of deals over this period of time in order for you to achieve this kind of outcome. And it's a more mathematical approach to it. And that way it doesn't apply just to me. They can take that roadmap and they can apply it to any deal. They can do a deal with you or Brian or myself or anybody on the market, because they're just trying to check the box. And they know that when they get to the end of it, it should, produce X returns.
Yeah.
Because it does require a lot. You need to have invested $2 to $3 million in equity for most people to achieve the kind of cash flow that they talk about. And so we don't have any investors that have done that much equity. Well, a couple, but for the most part, most of our investors have done, hundreds of thousands of dollars with us.
Yeah.
I love your hands-on approach with that, because I think a lot of, as I've gotten to know this industry a little bit, I think a lot of folks are just talking about, here's the deal that we offer, here's what you can get into and invest your money with us, but they don't always look at the big picture for the investor and what's best for them and provide that roadmap. So I think that's really cool that you do that and give them the ability to just, see it at a high level and then figure out where to go with it. So kudos to you. I think that's really cool. And I think you're putting the investor first, which also says a lot about your company, and just, not being so focused on if they invest with you, but what's best for them.
Absolutely. Appreciate that. Yeah, it really is. Honestly, it's more rewarding for myself when we sit down and we do these consultations with people. And because when you get to see the light bulb go off and they get to see that, we also track their age across the years, so they can see like, oh shit, I'm sorry. Oh, I'm going to be 68 or whatever. And I'll be retired, and then they get this big smile, and it's still 5-10 years from now, but they see somebody, it becomes a reality at that point. Somebody
see the light at the end of the tunnel. Yeah.
They can see the light at the end of the tunnel, something to strive for, versus just the generic, like, invest in multifamily. Like, that's a very blanket statement. And the reality is, if you invest, it's not just investing in multifamily, but it's investing in the right deals. So there's a time to do value adds, and there's a time to do Class A, and there's a time to do new development, and just knowing when that timing is makes all the difference.
Awesome.
Will that be in your book? I'm just curious, this roadmap, and I mean, what you're talking about is what you're outlining in your book.
It's in the book, and they can also just go to passiveinvestorroadmap.com we've got a domain for them, and they can schedule a consultation with us. Perfect. So it's something we're working on. We've got some generic templates for the average person, and then for the larger investors who need a more customized approach, we do that as well.
Awesome. Well, we are about out of time. And so one last question for each of you to wrap it up. How can listeners learn more about you? Joseph, you get to go first.
All right. So the best way to get in touch with me would be to go to our website, triarchrep.com, or connect on LinkedIn. If they like some of the information we've been talking about, if they're passive investors, they can go to multifamilychecklist.com. We've got a really cool 20-point checklist that they can have for free. And it's a guide that they can use to analyze deals better. So it's 20 points that they should ask or look for on every deal before investing in. And if they can't check all those boxes, then maybe they should probably not do that deal.
Twice. Awesome. Rebekah, same question for you. How can listeners learn more about you?
Yeah, so I'm pretty active on LinkedIn as well. I think there's probably some other Rebekah Taylors out there. My name is spelled Rebekah. And so if you look for that one, and I guess there's a 1986 at the end, that's the year I was born. But anyways, that's probably the best place to find me. My email is yourtailoredhome@gmail.com. My last name, Tailored.
Perfect.
But my website's not up yet. Still in the process of getting that developed.
All right. And we're going to put links to those in the show notes so that people don't accidentally spell Rebekah the wrong way. So there we go. All right. Well, thanks for your guys' time today. Very much appreciate it. And this was a lot of fun.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.